Now, what we're seeing at the moment is a cyclical downturn, a very sharp cyclical downturn. In many ways, that cyclical downturn is as big or bigger than we saw at the time of the 2008-9 global financial crisis, which is clearly a reason to be worried. Normally, in these periods of tight liquidity, you get some sort of financial disaster of some form, whether it's a Lehman moment or whatever. It's very difficult to predict ahead of time. And that's why we're cautious about the credit cycle looking forward 6 months. And that's why we fully expect central banks to come back and pivot, because liquidity is so important into the system.
Welcome to Real Vision. I'm Ash Bennington. I'm joined today by Michael Howell of CrossBorder Capital to talk about global liquidity and its implications for the global economy and capital markets. Mike, you're one of my favorite guests here on the show and a favorite guest of many of our viewers. But for people who may be seeing you for the very first time today, what is liquidity? How do you measure it? And why is it so important in your view?
I think the first thing to say is that there are two ways of looking at liquidity. One is the way that maybe traders or sales guys look at it, which is market depth. In other words, that looks at the ability to transact in security markets around current prices in size, in the required size. So that's a very technical definition. What we're looking at is something very different. We're looking at what we call funding liquidity. In other words, it's the ability of somebody to actually enact the transaction, have the credit backing or have the funds available to do that. So we're looking at funding liquidity, and generally we think of liquidity or global liquidity as a balance sheet concept. It really measures the capacity of capital in the system, but it really is a measure of the flow of money. Think of it as the flow of money through all financial markets worldwide.
So in the case of the first definition, you're talking about, for example, a specific security, which you could say, hey, this security is not very liquid, meaning that there are huge bid-ask spreads. When you buy or sell, the price may move dramatically, even though you're doing it in small size. But in your definition, you're talking about the global funding liquidity, the amount of cash that's flowing through the system that enables buyers to effectively enact transactions in the first place.
Correct. And you would expect market liquidity to derive from funding liquidity. So if market liquidity starts to deteriorate, it's really a heads up to the fact that funding liquidity is already going down significantly. And that's very much the case at the moment. There's a lot of indicators that one can take looking at deteriorating bid-ask spreads, the fact that new issuance is actually very low right now, the ability to get deals away is limited. And if you look at the number of failed trades that are passing through US primary dealers in the treasury market, that's starting to pick up quite significantly, worryingly so, in fact.
Mike, walk us through that in terms of how you measure that.
How we measure liquidity is maybe more straightforward. What we're looking at is the amount of cash that different entities, for example, central banks, for example, private sector banks, high street banks, shadow banks, cross-border investors, basically put into the system. It's their general credit creation within financial markets. Now, just to be absolutely clear, what we're not looking at here are the traditional monetary measures, such as M1 or M2. Those are much more retail definitions of money. They don't really have a lot of bearing on financial markets. They're much more real economy concepts. In many ways, the liquidity measures that we look at pretty much kick off from where traditional monetary aggregates like M2 end.
So explain what those measures are that you use and how they fit into the thesis.
Okay, I think the easiest way to see this is to basically start to question what the financial system really does. And if you pick up a textbook, an economic textbook, what they're really saying is that the financial system is a new financing system. And that's how we understand it. So interest rates are important. In fact, that is now completely wrong in many ways. The financing system is really a refinancing system. And it's a refinancing system because there's huge amounts of debt out there. If you think of the debt load that the world economy has got, it's now something like $350 trillion. That debt has an average life of about 5 years, which means you've got 70 trillion of debt to refinance every year. And that's where liquidity becomes very important. It's not interest rates that matter in that context. It's the ability to get the roll on the debt. In other words, to refinance your positions. If you don't refinance your positions, you either default, or if you're a mortgagee, you're homeless. So it's absolutely critical. And traditional economic textbooks miss this refinancing element. Now, if you look at the new financing part of the economy, with a world economy of about $100 trillion, let's say a fifth of that is capex, about half of that is externally financed through capital markets, or about $10 trillion. So what we're really saying is the 70 of refinancing compares with the 10 of new financing. It's a 7-to-1 ratio. So the system is really about refinancing. Interest rates are less important. The volume of liquidity is key. If you get slowdowns in liquidity, the ability to refinance is challenged, and you get financial crises. Financial crises are not about failures to finance new capital, it's to finance existing debts. And that's why if you look back over the last 20 or 30 years, all the major financial crises that we've seen have basically been problems about refinancing, whether in the repo markets or the mortgage-backed security markets or wherever it may be.
Mike, you have an interesting background. You, of course, were head of research at ING. You have a PhD in economics. For folks who are listening to this and hear echoes of Hyman Minsky in the framework that you have for refinancing, give us a little bit of a sense of what those risks are. I know that Minsky talked about these different types of borrowers and this risk of the so-called Minsky moment. Tell us a little bit about some of that framework.
Yeah, I think there are certainly parallels. I mean, we come from maybe a more practical than a theoretical perspective, but it's really the experience of seeing indigestion in markets when you get these problems about refinancing. And that's why we put particular stress on the liquidity dimension and how global liquidity, which is a pool of about $170 trillion, which moves quickly around world markets, is critical to this funding equation. Central banks don't really seem to understand that dimension. Central banks are focused very much on interest rate setting, and they seem to lose sight of this liquidity fact. And if you listen to what central banks are doing right now, what they're trying to do is to reduce the amount of liquidity in markets. For example, the Fed's desire to shrink its balance sheet. If you listen to what Jay Powell is saying, he's talking about potentially a 30% drop in the size of the Federal Reserve balance sheet. On our measures, that's a drastic slump. And the fact is that liquidity will have a non-linear effect on financial markets. So in other words, if you have a small drop in the size of the Fed balance sheet, it may not matter very much. But if you get a progressively larger and larger drop, then that matters significantly for financial integrity. And we would estimate that if the Federal Reserve is talking of this magnitude, maybe a 25% drop in the size of the balance sheet, from maybe 9 trillion to something like 6.5 or 7 trillion, what you're really thinking of there is the equivalent of maybe 4 to 5 percentage points additionally on Fed funds rate, not the 0.25% or 0.5% that the Fed glibly talks about. It's going to be much, much more important than that. This is a major squeeze in financing capacity.
Mike, as always, you've brought with you some charts that show visually what your framework is. Let's walk through those.
Mm-hmm. Okay, I think the first one to look at is what the global liquidity index, which is one of the first charts that I sent over, is really telling us. And what that's illustrating is the gyrations, cyclical gyrations of liquidity. But basically, the liquidity index that we calculate is now in free fall. So it's dropped from very high readings. The index we scale between 0 and 100 has dropped from levels of about 80, so very loose liquidity, to latest values as of the end of July of barely 20. So there's been a dramatic falling off in liquidity. Now, why does that matter? It matters because if you look at the growth rate of global liquidity, it has had an unparalleled correlation between that and asset prices worldwide. And there's a subsequent slide which basically shows that correlation. Now, one of the things that we indicate on that slide is the projection of global liquidity growth into 2023 and beyond. And that expectation or projection of growth is based on what central banks are telling us they are going to do with QT. This is gleaned from what the Federal Reserve has pronounced in terms of its runoff of treasury holdings. It's what the ECB implicitly have been saying about what their balance sheet will do as the previous support unwinds following the COVID emergency. And also what other big central banks like the People's Bank of China is slated to do. And if you look at that, the picture for liquidity is ghastly. It looks really bad. if you follow the letter of that projection, there will be financial dislocations in markets over the next 12 months. I don't believe that central banks will be able to do that because I think they'll have to reverse out. And that's why I think there'll be a pivot coming at some stage in early 2023. That pivot may not involve a cut in interest rates, but it will probably mean that the Federal Reserve at least sits on its hands for some time and digests maybe some of the damage that's being done here. So that picture is clear. One of the things that we ought not to be misled by is actually looking too closely and inferring too much about sort of very short-term Federal Reserve operations. One of the things you'll see in, I think it's a third chart that we show there, which looks at the Federal Reserve liquidity injections and the movements of the S&P 500 or the SPX index. What that shows is a very neat correlation between those two factors running back from 2019 onwards. And the correlation is remarkably tight, and it actually tightens significantly over the last few months. So the Federal Reserve has actually cut the effective size of its balance sheet already through other means, not by rolling off treasuries, but by the big uptake in reverse repos, which is a slightly wonkish concept, but it's basically the Federal Reserve selling own name bills back into the private sector. And also the rise in the Treasury General Account, which is a float that the Treasury keeps at the Federal Reserve. Those factors together have probably taken about $1 trillion out of the balance sheet, and they explain a large part of the slump in the market indexes so far this year. The interesting point is that the Fed appears to have flatlined in the last couple of months. There's no real impetus to that liquidity takeoff. And many people have inferred, I think wrongly, that QT has halted and the Federal Reserve is doing a stealth QE back again. I don't think that's correct. I think that there are technical factors that are buzzing around that are really stopping the Federal Reserve engaging the gears of QT quickly.
Mike, one of the interesting things about your work is that you tie the macroeconomic to the capital markets. What are the implications as you see them right now for different asset classes based on the view that you have from global liquidity?
Okay, I think the first thing is to look at some sort of template about how markets are moving. And one of the things that we show is a chart that looks, if you like, at the standard bear market behavior of the S&P. So what it looks at is a chart which shows the average movement of the S&P in a bear market. This is data which goes all the way back to 1970. We've indexed it so you get a sort of a standard run of what the market would look like. There's a sharp V as the market collapses and then a rebound on the other side. On that same chart, we plot liquidity, US liquidity in this case, with the red line. And what that shows is how liquidity leads the market and the sort of things that one can expect coming out of that. Now, generally speaking, and this is the thing to think of, and to bear in mind, of course, this is an average, every cycle is different, but this is the average look. What it shows is the market typically falls by about 25% in the first move down. That is when investors start to reassess growth in the economy, and it's largely because of central bank tightening. So in other words, it's when PE multiples start to collapse, and that's the phase that we've been in. Now, one of the things that you'll see from the chart is, interestingly enough, there's always an upleg, another upleg. In other words, that the market goes down 25%, it rebounds. That rebound has tended to average about 10%. It's lasted about 2 to 3 months on average. And then you get another leg down, a second leg down, which is based much more on a traditional credit cycle or earnings cycle when the economy is weakening and earnings numbers are being slashed. And that fall is normally of the magnitude of about 15 and 20%. Now, that tends to mark the low in the market. Coincident with that, liquidity conditions tend to spike up significantly. And it's around that low point that the Federal Reserve is on maximum warp for ease. Okay, we haven't reached that stage yet. We're still in the rebound phase. And that rebound phase may have gone a tad further than the average, but you get the idea that this is the normal sort of sawtooth pattern on the market. On the other side of the bear, what you see are dramatic increases in the indexes when liquidity goes in. The first leg up is about 25 to 30%, and then you get a subsequent 15% or so rise after a small pause. but this is fundamentally driven by liquidity. So that's really the steer that we're getting. And that's what we would suggest investors look at closely. We, of course, may be wrong, and the Federal Reserve may be doing a stealth QE now. It may be easing. We don't think it is, but clearly, markets are always there to embarrass us, so we've got to be open-minded. But I think the other thing to start questioning is what the fixed income markets are telling us right now. And I think therein lies a very interesting story that maybe is not in the conventional narrative. When we look at the fixed income markets, we look very closely at one dissection, which is between the implied Fed funds policy rate, the terminal policy rate that is embedded in the term structure of bonds. The second thing that we look at is what the term premium is telling us. Now, there's also a chart that we put in which show those two dimensions.
Let's explain those for people who may not know when they look at this chart. What exactly is term premium and why is it significant in this decomposition of price moves?
Okay. Term premium is a very wonkish concept, okay? If you want a full definition, go to the New York Fed website. They've got to do a fantastic job on actually explaining what term premium are and providing data. Basically what it is the premium or discount that you would expect to earn holding a bond above what you would get if you roll a one-year treasury every year for 10 years. So the 10-year term premium is that excess or discount relative to the one-year roll each year for 10 years.
And you're being compensated effectively for the illiquidity of that.
Exactly.
Versus having
so it's the compensation above interest rate expectations or discount. Normally what you'd expect is a premium. I mean, it would almost logically from a textbook standpoint not make a lot of sense if you actually had to pay a discount, because you'd almost be overpaying for a 10-year bond if you had to pay the market for that. In other words, it would be much more sensible to roll a one-year bond. But the trouble is that there's an awful lot of players in the market who have to buy 10-year bonds. And there's a hunt for duration out there. There's an awful lot of liability managers. One of the things that we've said many times before in conversations is that, if you look at how the flow of funds work in the US system, going back to 1985, something like 15% of the market was liability managers, people that had to buy the market, okay, come what may. Didn't matter about what their expectations for yields or relative yields were. They simply had to buy securities in certain measures because of regulation or because of duration or whatever. Today, that figure is as high as 42%. So there's a large constituency out there that have to buy. You can include in that passive funds, index funds. All of this is largely the result of legislation such as the Pension Protection Act of 2006, etc. All these things are really making for a market that is focusing an awful lot on buying things like duration. And that's one of the reasons why term premium can be biased at the moment or distorted. Now, to come back to the story, what you're looking at, if you look at that dissection, is two very interesting facts. One is that since the Federal Reserve or the last FOMC meeting, what is it now, three weeks or so ago, what you've seen is a initial drop in rate expectations from 3.4% to 3.2%, and they've latterly, as of the late last week, rebounded again back to 3.4. So in other words, there's been no net change in rate expectations over that period. And that's largely because Fed officials, a lot of Fed governors, have gone around to try and iron out some of the wrinkles or misunderstandings that followed from the press conference at the last FOMC. So Jay Powell sounded remarkably dovish, and I don't think that's the message the Federal Reserve has wanted to get across. So they've gone out of their way to try and, if you like, re-anchor rate expectations at a higher level. But behind that, what you've seen is a strong rally in the fixed income markets. And that's come from term premia. Now, the thing that equity investors ought to be worried about is that term premia have collapsed over that period by about 50 basis points. And that's pushed yields of the 10-year tenor lower. Now, why has that occurred? I can give you one of three reasons, okay, or maybe it's all three. It's either the economy looks really bad, okay, and fixed income investors are saying we want to own 10-year bonds because they're a safe asset, right? So park that thought. Second reason is there's a structural shortage of safe assets in the system. Okay, there's just simply not enough treasuries, or if you extend that globally, German bunds or Japanese JGBs in the system to serve as safe assets for these big institutions that want duration. That's probably true because we know the Fed has been buying an awful lot of treasuries in the last few years. We know the Treasury hasn't issued that much. And we know if you start to look overseas at the JGB market, the Japanese, the BOJ, the Bank of Japan, owns almost 50% of the total amount of JGBs outstanding. In Germany, there's only 10% left of the free float in the German Bund because the ECB has been hoovering it up so much. Okay, so there is a shortage of safe assets. And the third reason is it's a shortage of liquidity. And so there's systematic risks in the system with all these factors. And so investors want safety. And at the moment, they're prepared to pay for safety. The point being is that if we saw a bond market where rate expectations were falling, and that's the reason why bond yields are collapsing, then that would be equity bullish. But that's not happening. What's happening is its term premium are going down. And I don't think there's anything in the term premium data that is positive for the equity market.
So what's your outlook for equities based on that broader framework for global liquidity?
Okay, I think there's another leg down. We expected a rebound, maybe after this sharp drop in the first half year. We've been surprised by the intensity of that. So we're clearly, rethinking to see whether, or questioning our views to see whether they're correct. But we fully expect this next leg down. And that's because we think the economy is softening quite significantly. The data tells us that Asia is already in recession, that Europe is pretty much getting there, and the US may be a month or two behind. But we're certainly moving in that direction. The big debate, I think, at the moment is how deep that recession will be. We're pretty equivocal at the moment. We're not sure it's going to be a deep recession. We think it's going to be a recession nonetheless, but that is more likely to be a big earnings recession rather than an employment recession. And the reason we say that is that if you look at the fact of the last 2 years, the COVID crisis, the skills shortage, the fact that this recession has been probably the most well flagged of any recession I can remember, I think a lot of corporations are going to hoard labor. They will not want to let labor go quickly. So I think in that context, the employment numbers may stay elevated. That will put pressure on unit labor costs. That will hit profitability, and that will cause a big profit slump. Now, the irony in that is that may not be enough to move the dial for the Federal Reserve to start easing. Okay, because employment is their focal point. That's the lens they look through to gauge things. So you may get the worst of all worlds for equities, a Federal Reserve that is stubborn, but earnings that start to fall away.
This is such an interesting concept because this idea of an earnings recession in some ways is the mirror image of a jobless recovery. And when you make this point that you see the Fed effectively managing to levels in the labor market, it may in fact be, as you say, the worst of all possible worlds.
Correct. And I think that's why I think there's sort of I don't know about euphoria among equity investors, but I think their sort of nonchalance about the risks out there are somewhat baffling. Now, that may be that there is a bifurcated market in the sense that retail in the US are still very overweight and are buying US stocks, whereas the institutional and the hedge funds have actually pulled back quite significantly. That may all be a fact. But the data that we look at, which is looking primarily at positioning data, tells us that asset allocation into stocks generally is still remarkably high in the US. It's actually, as a word of warning, it's higher in a lot of other markets. Europe or Eurozone in particular, equity exposure is still very high. And they don't seem to have sort of clocked the idea that Europe faces some real challenges in the next 6 months over their energy supply.
There's something you alluded to before in terms of the patterns of retracement. This phrase that seems to be everywhere right now on Twitter and in the general financial sort of ecosphere. Bear market rally is something that you just can't avoid at this point. Is that a term that you find useful? Is there some sort of metrics that you look at to see whether or not that is a relevant sort of concept?
Well, it's a very relevant concept, Ash. I think that's for sure. It happens, and we know from experience of bear markets that these things can be, they can be vicious rebounds in price. I'm not a technician, but I've heard technicians say that if you go back and look at the NASDAQ sell-off after Y2K, I think there was something remarkable, like at least 12 days, where the market rose on average by over 20% on 12 days. I mean, that's a remarkable statistic, okay? And that's something you don't want to be caught up in, even though NASDAQ fell from beginning to end by about 80%, though those vicious snapbacks.
Yeah, indeed. Mike, just to give a little bit of a longer term framework to what we're talking about here, two charts that you almost always include in your decks that I find very impressive in terms of the long term durability of these ideas are the Global Liquidity Index chart and the Global Liquidity Long Term Cycles chart. Can you walk us through those two? Because I think it does give a kind of intellectual scope to the work that you're doing here.
Okay. In terms of the Global Liquidity Index, what that basically is doing is looking at the production or supply of global liquidity worldwide. And, the thing we stress is that liquidity is fungible. So you've got to take a global view of what's happening. And that's what we do. So we measure what central banks around the world are doing. We monitor over 90 central banks right now. We look at what private sector financial institutions do. That's including high street banks in different countries, shadow banks where appropriate. Shadow banks are big in the US, they're big in China, for example. They're not so big in Europe, but they're there. And then we look at cross-border flows of money that wing between markets. We put that together in an index. That's really a momentum index, if you like, of liquidity movements. And the reason we're looking at it as an index is it makes comparisons much easier, both across time and between markets. Now, what we're seeing at the moment is a cyclical downturn, a very sharp cyclical downturn. In many ways, that cyclical downturn is as big or bigger than we saw at the time of the 2008-9 global financial crisis, which is clearly a reason to be worried. Normally, in these periods of tight liquidity, you get some sort of financial disaster of some form, whether it's a Lehman moment or whatever. It's very difficult to predict ahead of time. And that's why we're cautious about the credit cycle looking forward 6 months. And that's why we fully expect central banks to come back and pivot, because liquidity is so important into the system. So that's the general picture. And in terms of the duration of that cycle, it tends on average, if averages ever work, to be about 65 months. So we're talking about, around about 5 to 6 years in duration.
Yeah, and this is the Global Liquidity Index long-term cycles chart that you're talking about with that 65-month wave in the red dotted line.
Yeah, exactly right. Exactly. Now, one of the things I think which is important to think of is who are the main drivers of liquidity worldwide. And this is a sort of mosaic that changes in many ways. So right now it's the Federal Reserve and it's the People's Bank of China. And to some extent, it's cross-border investment flows, but it's largely the former two, the Fed and the PBOC. That wasn't so much the case a decade or so ago. The Fed had been eclipsed by shadow banks, but the Fed has muscled its way back through regulation and through this dint of expanding its balance sheet. What the Federal Reserve is doing right now, as we said, is tightening. However, our indexes show the Federal Reserve flatlining over the last couple of months, and that's something I think we've got to think of and be realistic about, but we fully expect that index to go down for the US.
Let's talk a little bit about the constituency of that, because I'm looking at this chart. This was actually something that was very striking to me. Global liquidity, China has already overtaken the USA. Pretty striking, and something that perhaps many folks out there who are retail investors have not yet heard about. This is a pretty striking visual.
Yeah, I mean, in terms of the size, the People's Bank of China accounts for probably something like just over 30% of global liquidity, where the US domestic, let me stress, is about 25%. So China has eclipsed the US. I mean, this is the story about China overtaking in many different dimensions the US. And now there is a gap between Chinese liquidity and US liquidity in favor of China. But the fact of the matter is that in many ways, I use this term lightly, but China is the slave of the US dollar system. And one of the things that China is desperate to do is to get off that hook. It wants to try and create its own currency, or its own international currency, which is why it's trying to internationalize the yuan. And that fact or that desire ought not to be lost sight of, because that's China's goal. They've stated that. They want to knock the US dollar off its pedestal. They've said that. They want the yuan to be an international currency, particularly in the Asian region. Now, to get that, what they need to do is to make sure that the yuan is stable. And therein lies a very interesting puzzle, because the yuan currently is under huge pressure. We think that the Chinese took a decision around 2016 to move away from their policy, which up to that point had been growth at all costs, to one of stability, and particularly stability of the yuan. And what their goal was at that stage was to stabilize the yuan, to try and internationalize it. And one of the things you've seen in parallel along through that time period is the growth of swap lines by the PBOC across Asia. So they've enabled Asian central banks to borrow yuan whenever they want from the PBOC. Now, the only reason that that could be happening is that the Chinese are set to redenominate trade in yuan. Otherwise, there'd be no reason for these swap lines. So a challenge is coming. They've opened up the bond market. They've created a digital currency. All these things are basically en route to establish, if you like, an internationalization of the yuan. Now, the problem the Chinese have is that basically over the last few months, the Japanese yen and the Korean won have been very, very weak. In fact, the Japanese yen devalued from early March through early May at an annualized rate of 82%, an eye-watering amount. I've never seen that in financial markets. And that is unlikely to be a market-determined fact. Only governments do that to currencies. So there is some engineering going on to destabilize the Asian currency system. And that may be something that's been done in collaboration between the Treasury and the Japanese Ministry of Finance. Who knows? But it's had the desired effect, because basically the Chinese yuan has been unsettled. And as a result of that, the Chinese PBOC, the People's Bank, has been tightening liquidity in markets. Now, frequently, you will pick up the financial press and read that China is about to embark on a major easing program. Again, this morning in the press, there was headlines saying China has slashed interest rates. Well, hang on a second, let's get real about this. They cut rates by medium-term lending rates by 10 basis points, okay? There's no need to jump up and down about that. It's pathetic, okay? It's purely a symbolic move. It has no real effect. And actually, they took liquidity out of the financial markets this morning. That's not a central bank that's easing. Over the course of the last 4 months, the Chinese have taken $100 billion out of their money markets. That's not a central bank that's easing. That's a central bank that's trying to defend the yuan. And the result of this is tight liquidity coming out of the People's Bank. Now, the importance of that is that China's giant economic footprint, okay, means that if the PBOC tightens, the world economy effectively now catches a cold, because China is significant in terms of that economic impact. And that's one of the main reasons that the world economy is slowing down and why commodity prices are starting to dip down now. That's the issue. China is slowing. The print that came out this morning of Chinese GDP showed that it barely ticked positive in Q2. So all these indications are telling us there are problems there. They're fundamental problems. China cannot pivot until the Fed pivots or the dollar goes down. That's the reality. If they decide to pump in liquidity, which may happen after Xi Jinping's confirmation or reconfirmation of another term as president, that may occur later this year, in which case the Chinese are going to have to let the yuan go through 7. And that may be what we're looking at.
Well, you said it very succinctly before, this notion of the fungibility of global liquidity and how PBOC decisions are something that investors all over the world need to pay attention to. I was struck by your framework as you were talking about the strengthening of the rise of the yuan as a potential global currency. When you were talking about the central bank liquidity swap lines around Asia, I think for many people that probably brings back echoes of the Bretton Woods system with the US dollar. How long-term a project is this that the Chinese and the PBOC are embarking on? Is this a 5-year project, a 10-year project, or a 30-plus year project?
I think in true Chinese style, Ash, it's a 50-year project or a 100-year project. They have very, very long-term horizons. This is not an overnight, happening. They're building slowly and remorselessly. One of the things that didn't get very much press comment that came out of the BRICS conference, I think it was in June or July, or around the cusp of those 2 months, was the decision by the major BRIC economies to construct a rival currency for the US dollar against the US dollar. Read yuan internationalization. That's the subtext. That's what's basically going on. And they are trying to push for an internationalization of the yuan. But the key thing, or one of the key things, is maybe the growth of a digital currency. And maybe what we're looking at is perhaps this brick currency could even be something like a stable coin. Now, the threat that the US faces in this regard is not necessarily the direct challenge between a dollar and, let's say, an international yuan or digital yuan, because that's going to take years, decades to occur. The real problem is that China exports the architecture to actually create digital currencies to other countries. So maybe India buys the architecture, maybe Russia buys the architecture, maybe Iran et al. Buy that architecture. And that's where the US is going to face a gap, because once these things are embedded, then there's a problem. And the problem is that the US seems to be trailing seriously in the sort of construction of a regulatory framework for digital currencies or cryptocurrencies. The SEC seems to be tripping over itself, almost every day in hamstringing the project. It's it's a disaster from what we can see. The US needs to exploit its lead here in cryptocurrency and get out there internationally and exploit it. Get the dollar digital.
That's absolutely fascinating, Mike, because we hear so few people in traditional financial markets. We hear very few people, I would say, on the regulatory side making exactly that point, which is that the US's ability to digitize the dollar and to employ some of these new technologies that China and others have embraced is absolutely critical to US global competitiveness in the future and the decades to come.
Absolutely, 100% agree. Yeah, this is true. The SEC needs to look at this closely and start to promote US crypto, not try and hamper it.
I spend a fair amount of time in crypto markets, and one of the most striking responses, for me at least, in a place where we generally see a relatively laissez-faire attitude, hands off from regulators, was the speed with which Facebook's Libra, later Diem, was shut down, perhaps because of precisely the kinds of concerns that you're talking about here with a digital yuan. Losing control of the monopoly on monetary policy was something that policymakers in the US just seemed absolutely unwilling to chance.
Yeah, I think that's right. But I think the hope in many ways is that what we're seeing is what I would call a sort of re-emphasis of the Bretton Woods system. I mean, there's a lot of talk right now about Bretton Woods 2 or Bretton Woods 3. I don't think that's correct. I think those are. I don't think you'll get a commodity-based currency system. Commodities are too volatile for that. But what you are getting, I think, is a reassessment or maybe a re-emphasis of the original Bretton Woods system. And in many ways, I don't think that went away. And if you come back to understanding what Bretton Woods was really all about, it was really about three things. It was about the US dollar being at the center of the system. Well, that's basically persisted throughout. It's benefited from the petrodollar, from the emerging market take-up, etc. But the dollar is still very much at the center of the system, the dominant currency. So tick that box. The US military is part of that whole framework as well. Look at who polices worldwide. I mean, basically the US Navy. They keep the shipping lanes open, and that's an integral part of this whole framework. And then thirdly, who polices individual countries is the IMF or the World Bank, generally known as a sort of the Washington Consensus or whatever. But that's basically how the discipline is enacted. So what you have is the, if you like, the three pillars of Bretton Woods still very much there. Now, okay, we've got floating exchange rates, but hey, that was never really the critical part because under Bretton Woods, currencies changed their parities anyway. It just so happens that people associate that with a fixed currency system. It's not necessarily. It's all about the first three factors, the three pillars. And that is back again. Effectively, Bretton Woods was about supplying capital, allowing the free flow of capital and trade amongst the free world. Okay, that excluded China. It excluded the Soviet Union as it was then. And now what we're looking at is a reconstruction of that former domain, I would suggest. That's what friendshoring is all about. That's Janet Yellen's flag. That's the one that she's waving furiously. Go back to the Atlantic Council speech she made, I think, back in April. That was all about friendshoring.
Explain that, Mike, for people who may have missed it.
The friendshoring idea, as I understand it, is basically if you're a friend of the US, you will get trade benefits. You will have the ability to borrow dollars. One of the things the Federal Reserve has set up over the course of the last few years are swap lines around the world, but those swap lines which facilitate the ability of central banks in those offshore jurisdictions borrowing dollars in case they need dollars for their corporations or whatever to fund debt or whatever the reasons may be for transaction purposes. They can borrow directly from the Federal Reserve. So think of it as a sort of branch office of the Federal Reserve opened overseas, and that is a swap. That's effectively a swap line. Those swap lines are big or potentially big when the need arises, and the Federal Reserve is basically doing that amongst its friends. If you're not a friend of the US, so let's say you're a China or an Iran or maybe a Russia, forget the ability to access those dollar swap lines, and that's the whole idea about friendshoring. It's essentially recreating the parameters or boundaries of the former free world, and that's what I think that both Janet Yellen and Blinken, who's also made similar speeches, are really on about.
What's interesting about friendshoring, as you describe it, is it's perfectly congruent with the fundamental precepts, as you frame them, for the Bretton Woods system.
Exactly. It's re-emphasizing Bretton Woods 1. And I don't think Bretton Woods 1 ever went away, but we can debate that one.
Let's talk a little bit about some of the concepts that you mentioned as you were discussing global liquidity. Two things in particular stood out to me. The first was balance sheets, which you touched upon. Give us a sense of where we are, particularly with the Fed and as well with the ECB and other relevant central banks, for balance sheet unwind, what that process looks like.
What it looks like is essentially, you can think of it in two ways. One is that if you take emergency support that central banks gave to different corporations or banks through the COVID crisis, that those emergency funding lines are being run down. They were already, this is particularly true in the Eurozone, they're already of finite length and they're being essentially non-renewed and they're rolling off, okay? The second thing is that what you're seeing as well is that the stock of treasuries, in other words, government bonds that sit on central bank balance sheets, which are a major component of those balance sheets, are being reduced in size. So the Federal Reserve is slated to reduce its balance sheet from $9 trillion US dollars to something like $6.5 trillion at the end of the QE process. You get a very similar contraction in percentage terms by the ECB if you follow through the absolute letter of what they claim to do. Now, that generally, if you add to that, I should say, with what the People's Bank of China isn't doing, in other words, they're not easing. They didn't run up their balance sheet sharply in 2020 or 2021, and they're not contracting them now, but they're effectively flatlining the balance sheet. Look at that in aggregate. These are the three big central banks worldwide. And what you conclude is that basically for the next 2 years, on paper at least, central bank liquidity is falling by about 10 to 15% in each of those 2 years.
And just so people can see this visually, we can put up the Fed chart of assets minus liabilities where you can see the balance sheet absolutely exploding during the 2020 to 2022 time period, during the COVID time period, rising from approximately $4 trillion to where we are today, which is just under 9. And as you see what Mike is talking about there, that beginning of a rollover, a deceleration, followed by an absolute decline in very small terms on the Fed's balance sheet.
Yeah, exactly. So if you then extrapolate forwards into 2023 and 2024 and beyond, what the central banks are talking about is maybe reducing that total, in the case of the Fed, from 9 down to 6.5 trillion, which is a whopping great drop. And if you aggregate that worldwide across all central banks, you're talking about the next 2 years at least 15% drops in the size of central bank liquidity. Now, these are big numbers, okay, given the fact that we've never seen anything like that before, let's say. And I don't believe they're going to be able to do that because liquidity is so important. It will create funding problems. And that's the issue that investors have got to start thinking about. Now, from a positive point of view, as soon as the Federal Reserve and other central banks pivot, then markets will explode upwards. Risk assets, what you want to buy, you want to basically load up on long duration investments like cryptocurrencies and tech stocks. But please not now, okay? We've got to keep our powder dry for when that happens. But essentially, those are the investments that should do well. And they were the ones that did well when liquidity was abundant in 2020, 2021. And then the investments that have done terribly as liquidity has been sucked out of the system. So that's the pivot we've got to think about. It's not happening yet. It may be 6 months away, but we've got to be looking at the data to see if this is happening. And as I say, don't be deluded by the fact that the Federal Reserve seems to be behind schedule on its QT, because there are various technical factors that are coming in to do that. I mean, one is that they may be constrained by principal repayments, the timing of principal repayments. They may be constrained by the fact that mortgage-backed securities can take up to 90 days to settle. So in other words, the arithmetic of the balance sheet may not correspond to what people have hoped, but in fact, the direction of travel is still towards a much lower or smaller balance sheet.
The second point I wanted to touch on in terms of open market policy was what's happening right now with reverse repos. I think this is a concept that's very frequently misunderstood. First of all, 50,000 foot level, what are reverse repos? Why are they important as a transmission mechanism? And second, what do you see happening in terms of the trajectory with that policy right now?
Okay, the easiest way to think about what reverse repos are is to think of it as a Federal Reserve security or short-term bill that's issued to the markets, okay? And in other words, that it's a substitute for a Treasury bill. Now, the reason that that's occurred, or reason that reverse repos have occurred, is that the Treasury itself has slowed down dramatically the issuance of Treasury bills. They've started to issue more coupons, in other words, more bonds, notes and bonds, and fewer bills. Bills were very much in vogue during the COVID crisis. There were a huge number of bills then issued. But the Treasury has cut that back. It says that it wants to reduce the bill proportion of debt, I think, to about 20%. But they've also recently announced, I think, a cutback of about $600 billion in their bill issuance program. Now, why is that important? It's important because the money market funds, particularly the prime funds, are big buyers of Treasury bills, right? If there are no Treasury bills around, or to put it another way, if the inflows into money market funds from investors are so large, there's going to be a shortage of quality paper for these money market funds to buy. And therefore, the money market funds turn to the Fed and they start to buy up these bills, the so-called reverse repos, as I say, which think of it as a bill, from the Federal Reserve. Now, those bills are backed by treasuries. They're repos, reverse repos, so it's the opposite of a repo transaction. And what that means is the Federal Reserve's balance sheet has a large item on the liability side, which is called reverse repos. Now, as it happens, that is a withdrawal of liquidity from the money markets, okay? I think this sounds all terribly wonkish, but the balance sheet may stay pretty much where it is in size, apparently, but the impact of the balance sheet on money market liquidity is shrinking because of these reverse repos, which are taking money directly out of the money markets. And that's why I said earlier on that the key thing to think about is the effective size of the Fed balance sheet after you've stripped out these reverse repos and the Treasury General Account, which basically are both liquidity absorbing. Now, the problem with the reverse repos is that they're starting to escalate in size. And the growth in reverse repos are one of the reasons why a lot of liquidity was sucked out of money markets in the first 6 months of 2022. And that, I think, explains quite well why the market went down. And I go back to the chart that I was talking about earlier on between the effective size of Fed liquidity injections and the S&P 500. It almost tracks one for one through this period. And the recent flatlining in those balances is why the market's now picking up. Now, what could happen to reverse repos? The answer is they could keep going up, okay? Some estimates have suggested, even official, semi-official estimates from the Fed suggest they could be up as high as $3 trillion, in the not too distant future. They're currently about 2.4 trillion, but they've really come from nowhere. I mean, you look back 2 or 3 years, the answer was they were actually zero in size. So they've come up a long way. And the reason they could grow even more is that during a period of rising rates, money market rates rise faster than bank deposit rates. So there's a great incentive for investors to start to shift out of the banks to disintermediate and to go into the money funds. Now, that means the money funds are getting bigger inflows. As they're getting bigger inflows, they're wanting more government paper to invest in, and their demands for reverse repos will go up, escalate, because the bill supply is not that great. The Treasury bill supply is not that great. Therefore, they're forced into the Fed, and the Fed basically has to supply through auctions those reverse repos. So that's another factor which concerns us, because it may even mean that the drop in the Fed balance sheet actually starts to accelerate faster than some people have been suggesting.
Mike, we follow a lot of macro themes here at Real Vision, two of the principal ones being inflation and employment. We also got a very dismal print today on the Empire State Manufacturing Index. Do you look at these numbers as potential leading indicators of liquidity, or do you see them as something that are exogenous to your model?
They're actually indicators that are very relevant to look at. We monitor the Empire State Survey very closely because it should be confirming what we've already seen in liquidity. Liquidity conditions tend to lead the real economy by about 12 months. So the fact that liquidity is already going down sharply, has been going down through this year, is a heads up to say the economy should be softening right now. A number of the leading indicators we look at suggest that you've got a soft patch upcoming. Clearly, data blows both ways. The other data that came out today was the Cass Transportation Index, which kind of shows that transportation volumes have flatlined in the US over the last few months, which is a curious head-scratching phenomenon. But generally, I think the tone of the economy is weakening, but the US economy is not weakening as fast as Europe or Asia. And that maybe is a testimony to its underlying robustness, but it is going down.
Mike, always a great conversation. Always a pleasure to have you here on Real Vision. As we come to the conclusion of this chat, could you give us a little bit of a framework for how you're thinking about asset markets going forward?
Yep. I think right now I would like to be in the front end of the Treasury market. I think if you can pick up 3.2% or clip 3.2% from 2-year Treasuries, that's pretty good right now. I think we're going to get a downdraft in the markets maybe in the next quarter. I think September is going to be a challenging time for markets because there'll be a lot more economic data. We'd have had the Fed pronouncements from Jackson Hole. I think they're going to reiterate the fact that QT is a little bit like an air conditioning machine. It's whirring in the background, dropping the temperature of the markets the whole time. But the Fed seems to basically take the view that this is not going to have a devastating effect. We kind of differ from that. We think it could have a devastating effect, and we think the Fed will be ultimately forced to pivot. Nonetheless, the next few months will be a challenging one for markets. The bond market's are already giving us a heads up on that. I think that the long end of the bond market is maybe a 50-50 buy at the moment. If you believe in a deep recession, then go for the 10-year. I think that these levels, it's a little bit more equivocal. So we prefer the front end. I think if you look at corporates to move out along through the capital stack, I think at the moment I would urge caution on corporates. But a lot of these high yield issues are actually on a 12-month view are not far off break-even yields, I would suggest. So maybe there's a time for sort of putting the toe in the water. Equities, I still think that the US market is probably the best one internationally, but I still believe there's downside to occur. I wouldn't want to be in emerging markets right now. I wouldn't want to be in Europe, and generally, I think the US is the safe haven. And what the bond markets are really emphasizing is that investors in bonds want safe havens right now. So that's got to be a message for equity investors generally too.
Thoughts on the dollar?
Dollar, I think there's two ways to look at the dollar. One is the use of the dollar, and secondly is the level of the dollar. Is the dollar going to be eclipsed by a Chinese yuan, international yuan? No way. Not certainly in the short to medium term. In the long term, it's anyone's guess, but I think the dollar is absolutely dominant right now. And I think the dollar gets stronger. I think it gets stronger because we've seen that currencies like the yen or the euro are actually underlying flaky. I think the euro has got to devalue a lot more than it has already. And if you look at the companion move in the yen, and the euro is clearly an alternative to the yen in international markets in terms of trade, you're really looking at another 10 to 15% down, I think, in the euro. So I think that they're going to struggle, particularly with the huge debt problems they've got in the Eurozone. So I think that from that perspective, what you've got is dollar dominance in terms of use. I think in terms of price, I would expect the dollar after this big rally to have something of a sideways move. But I still think the dollar has got the scope in the medium term to move upwards, really because, where else does one go in the world for safe assets? The US has almost got the monopoly on those right now.
Mike, once again, demonstrating why you're one of our favorite guests at Real Vision, connecting the complex world of global macroeconomics to capital markets, currency markets, and money markets. Michael Howell, thank you so much for joining us.
Good. Pleasure, Ash. Thank you again.
What's up, guys? It's Ash Bennington again. I wanted to join you again for 3 quick takeaways from my conversation with Michael Howell. First, in Mike's view, to use his words, there's an unparalleled correlation between the growth of global liquidity and asset prices worldwide. I would add, when you look at the long-term charts from CrossBorder Capital, you can see this correlation illustrated over a long time horizon, not weeks and months, but years and decades. Second, CrossBorder Capital Global Liquidity Index is now in a free fall, according to Michael. It's plunged from a level of around 80, which represents loose liquidity, down to barely 20 in July. So a dramatic decline in liquidity there. Finally, based on the forward guidance from global central banks, particularly from the Fed and the PBOC, that's of course the People's Bank of China, Michael sees the outlook for global liquidity as ghastly. Michael believes a pivot is coming, possibly a pausing in central bank monetary policy tightening. Third and finally, speaking of the People's Bank of China, Michael now sees the Fed and the PBOC as the primary drivers of global liquidity, with cross-border investment flows playing a supporting role. But what's most interesting is that China has overtaken the United States as a driver of global liquidity. The People's Bank of China, according to data from CrossBorder Capital, now represents just over 30% of global liquidity, whereas U.S. domestic liquidity is now approximately 25%. But China is still at the mercy of the U.S. in many ways, according to Mike, in the current global financial system. China is key to stand up its own currency, the yuan, or a future incarnation of it, as an international currency to compete with the U.S. dollar and to knock the U.S. dollar off its pedestal. Food for thought. Thanks for joining us on Real Vision. I hope you enjoyed the conversation.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.